Hey guys, I want to share with you how my small investment portfolio did this last month. So grab your folders and let's dive in. My account is sitting just above $3,687 and has an account gain of $354.50. My lifetime dividend payments are $55.37 and my projected future annual income is $83.27. My dividend yield is fairly low, sitting at 2.26%, and my yield on cost is 2.5%. This is one of my favorite metrics to see increase over time, and my hope is that as long as these companies continue to steadily increase their dividend payments and perform well, this number will continue to grow every year. A more drastic example of this is Warren Buffett's Coca-Cola holdings. Berkshire Hathaway acquired 400 million Coca-Cola shares in various lots between 1988 and 1994. The investment holding company spent around $1.3 billion to acquire its shares. After over 30 years of appreciation, those shares are now worth around $25 billion. Its 400 million shares generated $776 million in dividend income in 2024. Thus, its annual dividend yield on cost averages almost 60% of its initial investment cost. Wouldn't that be nice? As of filming this video, my three biggest winners are AT&T, up 70.16%, IBM, up 56.24%, and 3M Co., up 43.33%. It's interesting because my three biggest winners are three stocks that many dividend investors are concerned about. AT&T and IBM both have dividends that may be unstable, and 3M Co. were dividend kings up until recently when they cut their dividends. I have no plans on purchasing any more of these three companies anytime soon, but it is nice having that growth, even if the dividends may not grow in the short term. It would take a whole lot of 3, 4, 5% dividend payouts to get to a 50% return. My three biggest losers are Merck, I'm down 24.82%, Edison International, I'm down 23.94%, and Lockheed Martin, I'm down 20.05%. This is one of my newer positions. Some of you may not have heard of Edison International, stock ticker EIX. They are the company that owns Southern California Edison, a utility which has been in the news lately after a handful of devastating fires that happened in January. Due to the concern of lawsuits and other related concerns, the stock took an absolute beating, dropping from an all-time high of around $87.75 down to $49.06, an 11-year low. Despite that, I'm still a fan of this stock in the long term. What do you guys think? Would you hold or sell AT&T or IBM up 50, 60+%? Would you trim your big losers in your dividend portfolios? Let me know in the comments below. My current stance is to just leave them there and gather more data. My savings account has $1,650 in it. My HSA is at $2,000. My work retirement plan is at $11,199.21, and I own 3 shares of Rivian. This month, I invested $100 in my account, split evenly between Bank of America and Google. That $100 bought me 1.107 shares of Bank of America and 0.271 shares of Google. This makes my Bank of America position 3.2% of my portfolio and 3.3% of my yearly dividend income. My current goal is that the finance sector pays 10% of my yearly dividend income, and after this purchase, it sits at 9.941%. In my Google position, sits at 1.8% of my portfolio and 0.4% of my yearly dividend income. My goal is that the communication services sector pays 8% of my dividend income, which it now sits at 6.656%. At their current dividend payouts, my yearly dividend income increased by around $1.37 with these purchases. Along with those purchases, in the month of February, I received 7 paychecks. MasterCard paid 22.8 cents. John Deere paid 74.7 cents. Apple paid 9.5 cents. Realty Income, my only monthly paying dividend stock, paid 65.1 cents. Caterpillar paid 59.7 cents. Costco paid 10.3 cents. And AT&T, with my largest dividend payout this month at $1.28. This is also my 4th largest dividend payment ever, for a total of $3.70 in the month of February. Compared to February 2024, which only paid me $1.31, meaning my AT&T stock alone nearly paid me as much as I made in the entire month of February last year. This is one of the fun aspects of starting an investment account. The numbers percentage-wise increase drastically, even month to month. The months November, August, May, and February are my lowest paying months based on the companies I own and when they historically pay out their dividends. That being said, as long as I see the trend line going up, I'm happy. Speaking of trendline going up, of the 34 companies I own, 6 announced they were increasing their dividend payouts. 3Mco announced a 4.3% increase to their dividend payment from 70 cents to 73 cents. Pepsi announced a nearly 5% increase from $1.355 to $1.423. Realty Income announced a 1.52% increase. Walmart with a massive 13.25% increase from 83 cents to 94 cents a share. Coca-Cola with a 5.15% increase, and Domino's Pizza with a massive 15.23% increase. And notice these last three are a good chunk of my portfolio. These 6 increases add $1.03 every year to my dividend income and increased my yearly income by 1.25%. Because of increases, next February is projected to pay over $3.73, even if I don't add any more capital to those stocks, or the companies don't increase their payouts before then, which, historically speaking, I do expect there to be more dividend payout increases. Across all 34 companies, my portfolio has an average of a 9.71% 10-year dividend growth CAGR. But it's important to note that although these companies are growing their dividend payouts at a good rate, their average 5-year earnings per share growth sits at 8.87%. This also is a healthy growth rate, but unless companies are willing to increase their free cash flow payout rate, they may slow down their dividend growth to keep their payouts relative to free cash flow steady. A good example of this is Visa, stock ticker V. It currently pays out $2.36 a year on an estimated $11.27 earnings per share. That means it's paying out roughly 20.94% of its free cash flow as dividend payouts. But because their 10-year dividend growth CAGR is nearly 5% higher than its estimated long-term forward earning per share rate of only 12.43%, you see the payout ratio increase dramatically. This means that in about 10 years, Visa could be paying out nearly a third of its free cash flow to dividends instead of reinvesting that money back into the business. I always try to keep in mind that although a stock may be growing its dividend payments well, the earnings per share and free cash flow has to increase at either the same rate or faster for dividend growth to be sustainable. I think a lot about how I want to balance my portfolio, and I update my goal percentages probably once a month. For the month of February, here's the breakdown by sector of where I would like my dividend income to come from. Here you see my goal percentages and where they actually are. Pretty close, and I'm happy with my progress. I'm probably one of the few that would have industrials as their main sector, but I love the defensive type stocks, and waste management stock ticker WM is one of my favorite companies. Comment below your favorite sectors and how you approach balancing them. I'm curious to see how others are approaching it. Also, you may notice that I break down my sectors based on income and not by value. Because some sectors have larger dividend yield percentages, I don't want to get stuck holding too much or not enough of certain sectors. Take the real estate sector, for example. My realty income and VG properties are only 4.94% of my portfolio by value, but 12.207% of my yearly income. If you're not careful, you can become overexposed to some of the higher yielding stocks in your portfolio, meaning your income is far less diversified than you think. This month, I invested another $50 into each of my 4 kids' custodial accounts. My hope is that as they get older, I'll be able to have conversations with them regarding personal finance and investing. That way, when they turn 21, they will continue to grow their accounts rather than cash out and spend it foolishly. And while $50 may not seem like a lot, given enough time and interest, its value will easily exceed many hundreds of thousands of dollars. Have you guys thought of retirement yet? If we assume that inflation is running at roughly a 3% increase year over year, after 30 years of inflation, an item that originally cost $100 would cost $235.66. Let's say your cost of living is $5,000 today. In 30 years, you would need around $11,783 just to keep the same lifestyle you have today. This is why it's important to buy stocks and companies that are not only growing their earnings per share, but also their dividend payouts every year. See you guys next time for what will be my highest paying dividend month ever. Shalom.